Okay, we're gonna start at 4 p.m. Singapore time, GMT +8. Just gonna wait for a few more people to stream in. Meanwhile, just leave this page on. For previous webinars, you can actually go to vantagemarkets.com/webinars to check out some of the previous webinars that we have done. And then if you have any other questions on trading with Vantage, you can email support@vantagemarkets.com. Here we'll begin in about 11 minutes. Today's an educational series on supply and demand zones. And also, before we begin the session, if you have any questions on today's session, you can use the Q&A function in Zoom to state a question, and we can go through them along the way.
Recording in progress.
For those who have just joined, it's just gonna take some time for more people to come in. We'll start the session at 4 p.m. GMT +8. So that will be in another 6 more minutes. All right, everyone, welcome to today's session. Good morning, good evening, good afternoon to everyone here, wherever you may be from. So today's session is by Vantage and Zeta Labs, and today will be part of the educational series, Mastering Chart Patterns and its Applications. We're going to use the Japanese candlesticks to actually analyze demand and supply zones. So before we begin, let me introduce myself. My name is Sherman, and I'm part of the Zeta Lab team that is basically focusing our efforts on technical analysis and algorithmic. Before we begin, I just want to highlight the risk involved in trading FX and any forms of derivatives. You have to make sure that whatever that's covered into this material, it's in line with your own trading objectives. Do reach out to any independent advice if necessary, and ensure that you fully understand the risk before making any trading decisions. So there was a prior session on candlesticks, so do check it out on how candlesticks are formed using 4 data points, the open, high, low, and close of each time period. And then with that information, we're gonna study how we can actually derive demand and supply zones from those candlesticks. And then we're gonna dive in a little bit on USD CAD and gold with some examples. And then we're just gonna close this session up with a summary. This session is only 30 minutes, so it might be a little bit rushed. If you have any questions, feel free to drop it in the Q&A section in Zoom, and I'll try to answer them as we go along, right? Okay, so let's begin off with the determining our demand and supply zone. In most cases, I think we are kind of aware of support and resistance. Demand and supply zones are basically the same thing, but in different terms. So in most cases, so when we talk about a demand zone, how do we actually identify a demand zone using candlesticks? We usually look for a point of a rejection. So given this, I'm just going to use this example. We have this upward movement, right, forming a higher high and a higher low, right? And this was the last low that was created, right? And we can see that once it reaches this zone here, right, there was this push by buyers to a higher price point. So in technical terms, at this point in time, sellers were trying to push the price down, but was met with an equal or greater force of the buyers to push the price up to a higher high, right? So this is a higher high. So when we talk about market structure, we always want to make sure that in a bullish trend, we're always looking for higher highs and higher lows. HH would mean higher highs, and the HL would mean higher lows. And so in this case, we can actually see that this is a bullish trend, and whenever a higher low has been formed, this will actually create a demand zone for buyers to re-enter the market. And that's the same for supply zones. We actually touched on that when we look into the examples. I think one thing that we want to kind of highlight when we look at demand supply zones, they don't always, it's not 100%. It's not a guaranteed area where we can buy, or in a supply zone, it's not a guaranteed area where we can sell. In a reversal pattern, right? In this case, where we see this demand zone, right? Sellers brought the price back down to this area, and buyers are actually looking at re-entering into the market. And we can see from all these wicks, right? The candlestick wick, right? Just want to touch on that a little bit. So given the time frame, and if you look at a lower time frame, a candlestick wick represents buyers who have already placed their orders at that level and are ready and willing to enter that market at that point in time, right? It's usually caused by pending orders. So orders are already placed at that point, and people are willing and able to buy at this point. So the wick is actually created when we see prices entering this demand zone, right? So how do we actually determine if this demand zone has failed? Is when prices have broken down below this level. And what that means in actual trading terms is that previously at this level, right, this was considered a discount for buyers to actually buy in, right? And sellers were trying to sell at this premium price, right? But as prices fell below this level, this price, due to some kind of event or due to some kind of new information, right, sellers are looking at this price as a premium price, right? So they're willing to sell at a previous discounted price. And buyers have already exited this market, given that prices have already fallen below this demand. So if you compare between the first zone and the second zone, right, it suggests to us that in the second zone, at this point in time, right, buyers have already a great portion of our buyers have already left the market, or a greater portion of sellers have already entered market, right, and caused this demand zone to fail. And once the demand zone has failed, right, what happens is that this will actually create a supply zone, right? What does it mean by a supply zone? It means that during this exchange, right, when buyers were trying to buy up, there was an equal or greater amount of sellers entering the market to push the price down. So this forms, and it kind of gives us an information that this is a zone where sellers are actually entering the market. And if prices were to ever retrace back to this level, that's where we can actually re-enter and take a position. So same thing again, buyers enter the market, sellers came in here to push the price below this level. And you can see that this, some of you might be familiar with terms like the break-off structure. So this was the higher high form based on this move upwards, right? But as it comes down, right, this becomes a lower low. Why is this a lower low? Because compared to the previous low, this low that we have identified, this is it has fallen below this price level, and when it retraces back, this forms a lower high. And as price falls again, these 3 points gives us an aggressive indication that the bullish trend has reversed, and we're now entering a bearish trend. So as long as it follows this condition, right, lower low, lower high, lower low, lower high, we'll always sell on the lower high. And there are many ways to identify where this lower high is. One way is to identify your supply zone. Find the area where buyers and sellers had a conflict, right? There was an exchange in terms of the buyers and sellers, and the sellers overwhelmed the buyers and pushed prices down further. And when it retraces back to this level, some of these sellers might still be in the market, and more sellers will enter to get out. So at this level, why this level will hold? There are several reasons. One reason is additional sellers entering the market based on new information. Number two, buyers who were trapped here wanted to buy this movement up, right? They were in a loss here at this level if they were not stopped up. And when it comes back to this level, they're closing out their buy positions. And when they close out their buy positions, it would sell, right? So that's the second level. So there are new sellers entering the market, or all buyers exiting the market. That will cause the continuation of a bearish trend. Okay, so in a sense, what we're actually looking here is that not all demand zones will mean a buy, right? When we see indications of a failure of the demand zone, right, we'll look for the new supply zone and sell, right? So otherwise, demand zones will be for buyers to actually re-enter a buy upwards, and sellers will be looking for supply zones to sell. Otherwise, if there is a failure, right, demand failure creates supply zones, and supply failures create demand zones. Okay, this is a zoom in. This is on the H4. Basically, the same thing that's happening in the previous picture. So at this point in time, right, there was a sellers were trying to sell into this level, and there was an equal or greater amount of buyers entering this level here. Okay, so and how do we know that? Because this move upwards shows us that buyers are willing to buy at this discounted price. And so the obvious move would be that if it were to retrace into the golden zone, 50% would be the discount. Some would buy at 61.8 retracement, or say 72 or 78.2 retracement. And this is a perfectly fine place to actually enter a buy. But sellers entered this position and realized that this is no longer a discount, but a premium for sellers to enter. And so price will be pushed below your previous low, forming this, this might be a higher high, or this might be a higher high. But this is no longer a higher low. This formation of a lower low tells us that we are in a bearish trend. And again, in a sideways moving market, we might be able to see such a phenomenon where demand failure leads to a supply failure, and then creation of demand zone. And so prices zigzag around this area, and you might be stopped out if you were to look for a swing in a range market. Okay, so again, not every demand zone is a confirmed buy, and not every supply zone is a confirmed sell. But what it tells us is that if any of this zone fails, it will create the opposite zone for us to actually enter in the opposite direction. Okay. Yep. So feel free to put in any questions you have on demand and supply zones, if you have any, and I'll try to address them as we go along. Okay. So again, your bullish market structure, we will always try to find a bullish market structure, and based on this this move here, we can see that this entire move here, right? How do we identify that it's a bullish structure, right? It forms a high, retrace, a higher high, higher low, higher high, higher low. And basically, you're in a bullish trend, you're always looking for a higher high to buy in, right? These are all new deep demand zones on the lower time frame, right? And then this was the initial demand zone that was created. So how do we actually determine these points here? We can use the Fibonacci retracements. So basically, we look at this move up, and once it starts to reject, we are looking at anywhere between a 50% retracement to the 78.6% retracement. Okay. You might get in at this point, or if the trend is really bullish, you might not get in, but the key is to be patient and to wait at these zones to get at a very at a discounted price to enter the market. Okay, so again, this demand failure here, right? It's really on a higher time frame. Based on this chart, there is this move upwards, and basically this was the last high, last low that pushed this price up. So buyers were entering here, and basically they were in profit at this point in time, right? So how do we actually look for reversal at this point in time? Is that we're looking for sellers to enter. And usually when you look at the market structure first, and then I'll talk a little bit more on the candlestick patterns. So this is the level for sellers to break, because there's a lot of buyers entering this level. If you are able to push price below this point in time, you're getting a lot of buyers out of the market, and that's where sellers have the opportunity to bring prices down lower. So we can see this price move down, and it's how do we actually what kind of patterns actually suggest that buyers actually being stopped out of the market is when you have big candlesticks For sell will be black candles in this case, right? Basically, the candlesticks, big candlesticks, will tell you that this is not a sort of like a manual entry by sellers entering the market, but by pending orders. So basically, your sell stops or your stop losses for your buy orders that have been triggered that cause such a big move in the market. And if you go down into your lower time frames, your 1 minute or your 5 minute charts, and you see big black candles, right? This usually suggests that these are all pending orders that have been executed by your systems that cause the price to fall really quickly without any form of support in that zone. Okay, so we can kind of see this move here, and of course we do not enter when the system is triggering all these stop losses, right? So this is where all your stop losses have been triggered, right? And this will actually create a new supply zone, okay? So how do we determine this new supply zone? Again, back to the point where at this point in time, the buyers are looking to re-enter a buy based on this upward trend, right? And once they hit this point, sellers enter the market with volume as well as the willingness to bring prices down lower. So at this point in time, there was an exchange of the bullish trend to a bearish trend. So more sellers are willing and able to enter the market, which pushes the price down lower. So this is the price that if we were to re-enter this position, we know that the existing sellers are still here with enough volume and enough ability to actually bring the price down low. So this is why you see prices rejecting this level. The second reason why prices will reject this level is that buyers will enter at this position, and as the price go down lower, two things is happening. Two things will be happening. The first would be that buyers who had stop losses were being stopped out, right? And those without stop losses, right, they are in a drawdown. And as prices return back to this level, they might have entered here to get back in a small profit here, or they had their buys left hanging here. And once it reaches back to this level, they close off their buy orders. And when they close off their buy orders, it's actually a market sell order, which causes prices to fall. So, okay, so these are the two reasons why a supply zone will be created. And as it rejects this level, it gives us more confirmation that this supply zone will hold based on the initial sellers, existing buyers exiting the market, and this will cause this whole wave down to the bottom. Okay, two things I want to highlight at this level here. Okay, so whenever we see such a pattern where, again, I'm just gonna go through what's happening at these price levels. So here, right, at this level, sellers are really entering the market. So buyers got in. It might not be buyers coming in, it might be sellers taking profit. Okay, because this was the previous demand zone, right? Sellers who sold off here are already in profit here. So small movements up are usually indicative of sellers taking profit, right? And if prices were to fall even further, then it's basically new sellers coming in, or buyers who entered here were being stopped out, and then you have this cascading effect for prices to fall even lower. Now, when we see such a movement where prices retraces 100%, right? So basically 100% and it move up. Usually when it retraces 100%, right, there'll be such a move down because sellers who entered here will see this price as a premium again and re-enter here. And so in this case, what we're actually seeing is prices falling a bit, right? Okay, prices are falling here. You can see that it touches back to this level here, and it went back down. So this is still considered a premium price for sellers to enter, right? For them to sell down, and we see this move upwards, and this would mean that all the sellers here, and maybe some of the sellers here, got liquidated, not liquidated, but gets stopped out, right? And it moved up to this level to form a new resistance. Okay, this resistance is determined by this fall, this move down, and this supply zone here will be created. Okay, so what happens is that every time you see 100% move, it's usually a very strong indication that prices are about to reverse. Same thing here, 100% move, right? So this created another supply zone. If it went down and retraces 100%, right? And what's up after this is that two things are happening here, right? Sellers who got in here, right? They did not manage to TP, right? Somewhere below. They will push back up to this level. Some of them close off their positions to break even, and you see this lackluster movement. What we're trying to find out is that this failure of the supply zone going to create a demand zone, right? And how do we tell if it's going to be a demand zone? Is that we see a price move upwards. But if price doesn't move, there's no confirmation that this is our new demand zone. We'll come back to test our previous demand zone. Okay, and we want to see a pattern like that, a higher high and a higher low, and form the market structure for us to get back into the market. Okay, I'm just going to speed things up a little bit because we're running out of time. But the concepts are the same. You can look at any time frames, you can look at any instruments. These candlesticks are just a reflection of what the traders are doing in the market with sufficient volume. And you have that 4 data points, open, high, low, close, and basically prints out the same patterns over and over again. At lower time frames, you're looking at smaller magnitude of in terms of pip size. At higher time frames will be bigger pip size. So the concepts are the same. You can apply to any time frames, you can apply to any instruments. Okay. So again, this zone here was created because sellers entered into this level and buyers came in here to push it up towards this level. So if prices were to fall back here, the expected behavior would be that buyers from here and new buyers coming in will push the price up this way, right? Sometimes it will play out like that nicely with a retracement into the golden ratio, which is the 50 to 61.8%. But other times you'll see patterns like that, and then before it blows up, right? And of course, you want to coincide that with events, fundamentals. If you're trading Forex, look at interest rates, and all of this news will actually help in terms of playing this pattern out. Okay, so this demand zone played out, right? Expected move was much earlier, but it took some time for us to actually get into this level again, and then before this explosive move up. And usually, like I said, when it moved up without any retracement, and the first retracement is 100% retracement, this usually means that all the buyers here who didn't get out at this level. So how do we actually, what kind of patterns will actually tell us that buyers are actually exiting is when we form a pattern like this, where some buyers are taking profits, some buyers are taking profits. But if it goes all the way up, sellers came in and brought the price back down, it's usually a reversal pattern, right? This is on the daily. You can look at on the daily, it might form a pattern like that, right? This inverted V shape. You might look at the weekly or monthly, and basically what you see is a white candle and then a black candle. And most of you might know that this, if let's say this black candle extends beyond our white candle, this is a bearish engulfing candle, right? So this is on the monthly. This might be on the daily, right? So they're kind of the same. So usually you look at monthly, tells you a pattern, and then you go down to daily to see what's going on, what's the magnitude, and what's the momentum here. So it comes down to this level. Our expectation is that this demand zone will hold and it brings the price up. but you know, if when it falls below this level, there's this cascading effect down, which means that there are a lot of pending orders here. Usually your stop losses or your sell stops or sellers entering here are pushing the price down. Okay, so once your demand zone is there's a failure in demand zone, it will actually create a new supply zone. Okay, so once the new supply zone is created, you're looking for a golden ratio retracement, which is, let's say, 50%, which is here. You might enter 50%, you might enter 61.8 or the 78.2 level. Okay. If you are scripting this, if you're writing an EA or using algorithm trading for this, what I'll do is that 78.2 would be my entry, right? And once this position has been entered, then there'll be pending sell stops for the 61.8 and the 50%, right? The key thing is that you want to get the most, when you're selling, you want to get the most premium entry in first, which is at the 78.6%. Because again, why are we entering at 78.6%? Because we know that if prices were to break the 100%, which is a V-shaped recovery, what we're going to expect is a move up, because your sellers are out of the market, buyers entered here, they are able to push the price up again. So 78.6 is sort of like the safest and the most premium price to sell. And that's why I personally, I will, if I'm going to script this, 78.6 is my first entry. And if this is being entered, I'll look for a downward move and a retrace to the 61.8 and 50% and write the wave down. Okay, that's kind of like out of the context of this session, but just a little bit more information on that. Okay, this is a zoom in image of what's happening at the supply zone. Again, if you're looking at the weekly demand supply zone, and you want to find, it's all the same across time frames. So once you have identified this weekly supply zone, what you want to do is basically zoom it down into the 5 minutes or the hourly chart, right? To find the same pattern, right? It happens on all time frames, right? This is your higher high. Let's say this is a weekly supply zone, and your candlestick is on the 5 minutes time frame. Okay. This will not be a high high. This will be a. Okay, let's take, for example, this is a higher high on the 5 minutes time frame. It forms a higher low, and it enters our supply zone, right? Our weekly supply zone. This is where we start to look for reversal patterns, right? So again, this week here, if it's on the 5 minute, it just tells us within that 5 minutes, there are a lot of orders placed to push price below this level. And usually this is not sellers at the computers trying to sell this price. It's usually pending orders, either sell limits, right? Or buy stops that were pushed into the supply zone, and sellers were taking this all of these buy orders into and selling them into back into this level. So this is not an engulfing pattern, so we do not know that this is a reversal yet. How do we know that this is a reversal? Is because this move up here. Let me just erase everything. It's getting very messy. So this move upwards. So this was where sellers were trying to, the first batch of sellers coming in to sell, because it already hit the zone, but there were not enough volume, not enough sellers coming in to sell, right? So buyers took a stand at this point in time. This level here, this is where buyers took a stand and pushed price up. Again, another batch of sellers coming in to push price down, and then buyers. So this zone here is where a lot of the buyers are defending at this price point. So buyers are thinking, this is a very good, this is a discounted price. I'm going to enter because of this move up, right? So what happens is that there will be a lot of stop losses below at this level. Stop losses are your pending sell stops, right? And then as the new sellers came in to sell at this premium price, all they need to do is to trigger this level. And it's quite evident because of this candle here, right? A big black candle pushing down. It's usually not sellers manually selling, right? It's usually all your stop losses and your sell stops that are executed at market and push the price down low. So this was the zone where there was an exchange between buyers and sellers. And so as it goes lower, right, if you were to retrace to this level, we are looking for a sell. So weekly sell supply zone, we look for a reversal on the daily, right, on a lower time frame, 5 minutes or an hour, and then comes down here before it pushes. So again, at this point in time, right, if this is the daily supply zone, for example, if this candle's this time frame is the daily time frame, you want to zoom into the 5 minutes time frame. Each candle represents 1 day. At this point in time, on the 5 minutes chart, you'll see a similar pattern happening. And so usually on a 5 minute, on a 1 minute, once it enters the weekly zone or the daily supply zone, right, you want to look for this kind of reversal patterns and then take a sell. So that's how they snipe the sell entries down into this level. Okay, I'm just gonna speed things up a little bit. Again, this is the same pattern. Like if you go down into your weekly supply zone and your daily supply zone, again, these two areas are where your buyers start to enter the market to push the price up. Okay, sellers, if you want to make a stand, you need to sell below this price to trigger your stop losses, right? And then this will create a new supply zone. Retest once, breaks, and then because this is the daily time zone, you can look at the 5 minutes, the 1 hour, look for similar patterns again. And then once you enter this position, look at this black candle here. It pushes below your previous this again on the 5 minutes are where buyers were trying to buy into this move up. Okay. Then your sellers came in to liquidate or stop loss or trigger the stop losses. Came back up here again. This is on maybe on the 5 minutes, a new 5 minute supply zone. And see this candle wick here touching, and then bring the price down again. So the same pattern across all time frames, across different instruments. Yep. Again, just to reiterate, this sort of formation of patterns, it's for all time frames, for all instruments. You can see again at this level a lot of candlestick wicks. And this is indicative of pending orders. So people are, for this example, buyers are already setting up their orders here to push price up, right? Given the time frame as well. So if you have at a lower time frame, you can see that if you can see wicks, they are usually a higher momentum than daily time frames or hourly time frames. So if you are on 5 minutes and you see a lot of these wicks, it shows that a lot of pending orders were placed at this level. Again, here you see a lot of wicks, and this is evident from this move up, right? Retrace back, and then the expectation is for a higher high. Okay, so one thing is that once you come to this level, you see a candlestick wick like this, followed by this is an inverted hammer, and then you have this black candle here. You can choose to sort of put your stop loss to break even, right? Because your expectation was that this was the expectation, a higher high for your buys. And if it doesn't form this higher highs, it means that your buyers are weak. It's coming back down. You want to get out of this market. And when do you actually change from a buyer to a seller is when your previous demand zone has failed, right? Sellers are now looking at this price not as a discount, but a premium to sell already. Okay. So again, you might not enter here, right? But this is definitely a confirmation of a change, a reversal, a change of character from a bullish trend to a bearish trend. So most of us will actually look at the retracement again. 50% is our premium price, 78.6% retracement. It's the best price to enter. Any price above this black candle would be a bullish engulfing candle, which means that buyers were able to get rid of all the sellers here, and prices would tend to move higher. Okay, but if prices remain, this will be your best entry to enter, right? 78.6, right, somewhere around here. Comes back down, And then once it breaks below this level where buyers put up a fight, right? Once it falls below this level, this will be your new supply zone, right? So you have entered once here, came down, you might have already TP'd. Usually the TP is that swing down. So this is your first TP. Second TP is 2x off this move down, right? Depends from individual, but usually when I code up scripts, it's the first TP is the first swing down, and then the TP here will be the second swing, and then there'll be a third TP for us below here. So again, once again, you entered here, right? This creation of a new supply zone. Once you have taken out your second TP, you have moved your stop loss to this level, right? So you might want to re-enter a second position. Here, it failed. You might have gotten out from your first sell. Again, failed again. You might have gotten out from your second sell at break even. And this black candle is a confirmation of a continuation of the trend. So you look at the retracement back to the 78.6, and then goes down here, first TP, and then second TP. So that's kind of how you usually look at the market structure and then re-enter into the trend. Okay, so again, the formation of this basically this was a fake out, breakdown lower. So you have a lower high, lower low. This was a fake breakout. And how do we know if this is a fake breakout? So usually you try to sell here, you get stopped out, right? Push price even higher, and it comes back down. This is a confirmation that this supply zone holds, right? And so when it re-enters here, you can sell and goes down. Okay. Again, this is a lower low, lower high. This is not a lower low, so you might have gotten out here. But again, because of this formation here, right, you would have re-entered here. It goes down. Okay, so this is this is sort of patterns that are common, might happen. And so just going to wrap it up a little bit. So the key thing here would be to identify your supply and demand zones. I think in most cases you might have a lot of indicators that's actually telling you a lot of things. But I think the key thing would be to follow a sort of strict rules to identify your supply and demand zones. Understand what's going on behind the scenes in terms of like the how buyers and traders are reacting to certain levels, right? And once you understand this pattern of how buyers or sellers can overwhelm each other in those zones, you're able to sort of snipe or find better entries. Okay, so supply zones don't always mean sell, and demand zones don't always mean buy. But what it suggests is that if your supply zone fails to hold that support, hold that resistance, or the demand zone fails to hold that support, it will actually create the opposite zone. And it gives you an opportunity to actually re-enter in the opposite direction. Always use the higher time frame direction. So there's always a primary trend, there's always a retracement for the secondary trend. Make sure that if you're starting out, we always want to follow the primary trend so that we have higher probability of following that trend and TPing instead of scalping the secondary trends. Okay. Candlestick patterns happen for all time frames. So start off from your daily or weekly and work your way down to your 5 minutes. You'll realize that these patterns always repeat itself. So if let's say you're on a bearish trend, you're always looking for a change of character before you buy, and work your way down to the 5 minutes to find or snipe certain entries at certain price points. Okay, so interactions between your demand and supply zone will always show this exchange of your buyers and sellers, and depending on whether or not there's sufficient volume from your buyers and sellers, will determine the direction that we should follow. Okay, so again, I'm just going to put whenever there is a move up or a move down, right, always look at the 78.6% retracement, which is a Fibonacci retracement. Can be any percentage, or the 61.8 or the 50%, right? So this is your 100, this is your 0%, this is your 100% movement up, right? you're looking at least at a 50% retracement or all the way down to 78.6. We do have a session on risk reward ratio. If you do it at a 78.6%, this is a 1:3 risk reward ratio. 61.8, this is a 1:2 risk reward ratio, and 50% is 1:1 risk reward ratio. Okay, I'm just going to briefly talk about this. We already past 10 minutes, but basically, when you look at a price reversal to the 50%, right? Let's say you enter here. This you enter your buy here. If it falls below, your stop loss will be past that 0%, right? We know that if prices were to fall below this level, it's a reversal, right? Based on what we have discussed earlier. So this is 1:1 ratio. Basically, this the loss here is equivalent to that swing high. So basically, our target is this point here, and if it goes down to the 61.8%, right? It's actually, this is one part, and then this is 2x of your stop loss, and if it goes down to 78.6, this is actually 1, and then you have 3 to the first TP. Why is this the first TP, right? Because of a formation called the double top or double bottom formation, where it's actually a retest. So if you go 50%, there's a chance that it might form a double top, right? Or if you're coming down, you sell here, and then there's a chance that it doesn't form a lower low, and basically it forms a W pattern, which is a double bottom, which is a reversal pattern for sells. Okay, I mean, it's a sell trend, it's a bearish trend, and then it's a reversal pattern. So for buyers to re-enter, and basically this forms your new demand zone. Okay, so a lot of stuff covered here today. I'm not sure if you guys have any questions. Feel free to ping me on via my LinkedIn if you have any questions related to today's session. But otherwise, any questions that you have for Vantage. So our previous webinars will be on this link here. And then any questions you have regarding trading or any instruments that Vantage is providing, you can email them at support@vantagemarkets.com. Okay, I'm just going to leave this here for another 3 more minutes. If you have any questions, you can put it in the Q&A. Otherwise, that will be all for today's session. Okay, I'll see you guys again in the next session. So keep an eye out on the updates from Vantage. All right, see you guys. Bye-bye.